today's video is sponsored by fastbull.com. Fastbull.com is just a one-stop shop for all your trading needs. They provide daily AI-generated trading signals to help you find the best opportunities in the market. You can also check out their economic calendar to stay on top of your important news and events that can impact the prices, so you know if you want to be in or out of the market. So make sure to check them out at fastbull.com or use the link in the description or pinned comment below. Now for this lesson, I decided to use my cell phone screen because I know that most of you are going to be using. All right. Now, let's say, for example, we are looking into the Euro USD, right? And this is our Euro USD right here. And the exchange rate for Euro USD, as you can see, this is the exchange rate which is in front of the currency pair. So you see the currency pair here, and then you are going to see the exchange rate here. So the exchange rate right here is 1.0878. That's the exchange rate, all right? And the currency pair, of course, it's Euro USD. So you can see here. So first thing that you need to be able to do is to understand and to read this exchange rate. What does this mean? This means this is $1, right? So it's $1.08. So if you are just talking about this amount of money, let's say in the streets, you are going to just say this is $1.08, right? But as a trader, you have another two numbers that comes after that. In this case, it's 78. So why is this number important? This is the smallest number that the currency pair makes, and we can make money from this currency, the last numbers, right? So a pip is a smallest movement that a currency pair can make. So let's write it down, right? So a pip is the smallest movement that a currency pair can make, right? So the smallest movement that you see, right? So if you look here, you're going to see that these numbers are changing. And the last number, right, which is the fourth decimal place, right? So the pip is going to be the fourth decimal place. Note that here there is a small number here which is floating above. That is called a pipette, and we don't care about that. That is going to be what determines the spread, but it's not up to you to determine that. So what you need to know is the fourth decimal number here is the pip that you have. This is the last number that moves. This is the smallest number that you care about. So if this last number here, which is the fourth decimal number, moves, right? So for example, if it moves from here, from it was 78 to 1.0879, right? It have moved with one pip, which is the difference between the first number and now the second number here. So let me show you how this works. So let's say another example is GBP USD. You can see right here, and the exchange rate is 1.2716, right? So we have the first number here, which is $1, right? And then 27 cents, and then we have 16 here. The last number, which is the fourth decimal number, is the pip. So if this number changes, right? So when this exchange rate moves, let's say it moves up, and let's say it moves to 1.2720, right? What is the number of pips that this exchange rate have moved on? We look at the last digit here and see, okay, if this last digit, it moved to 0 here, which means we added here. So what we do simply is subtract these numbers, and then we are going to get 0.0004, right? Which means this market have moved with 4 pips. So that's 4 pips right here. And these 4 pips is how you can calculate your profits and losses, right? So when the market is moving, right, we calculate the number of pips that it have moved on. and from there we know exactly how much money is there. So we can calculate this before the market moves, or we can calculate when the market is moving, right? So we can say, okay, right now I want to place a trade. Let's say I want to sell right here. I can calculate, of course, I want to sell, let's say, at this point right here. So I want to sell here, right? I want to know, okay, from my sell point here to, let's say, if I think that the market is going to move to this point, I want to know exactly how many pips is there from here to here. And then if I do that, I can know exactly how much money do I need to put into the market and how much am I going to make in dollars. We are going to talk about that. But first, let's talk about the other side of pips, which are called lots. So a lot is simply the size of your trade. Right, so when you are placing a trade, you determine how much money do you want to put into the market. Do you want to put $1,000 or $10,000 or $100,000? Basically, there's three types of lots. The first one is called the standard lot, which is represented by 1. Right, so if you go back into our market right here, you are going to see that on top here, we have where to put our trade size. Right here, we see here, I can change this to 1. If I change this to 1, and let's say if I click buy here, that means I'm buying and I have bought here. You can see that I have placed a trade with 1 lot size. And this trade started with a negative 14. As I said before, almost all your trades will start with a very small loss. But then most of the time, if you are right, the loss is going to be covered by the trade. But what I want you to understand here is that the difference between these two trades that are on so the first one is 0.01. This is called a lot. 0.01 simply means I'm risking 10 cents per each and every pip. And then 1 lot size, which is called the standard lot, it means I'm risking risking $10 on each and every pip. So let's go back to our pip for a minute and let's talk about and so that you can really understand what I mean here. So I placed this trade right around 1.0879. It's written right here, if you can see here. Then as I traded this trade, right, you can see if this market goes to the upside, because this is a buy trade, as you can see now, it's turning into a profit, right? So if the market moves to 1.08, let's say 89, right? This is going to be what? Let's do the math. We subtract here and we get what? 10 pips. If this market moves 10 pips in my direction, simply because I'm risking $10 per pip, I'm going to make $100. So the lot size is going to determine how much are you putting in the market. But on the same trade again, if this is the same trade again, simply because I'm using 0.01, I'm going to make $1. And you might say, who needs to make $1? Well, it depends on your account size. Here I can place a standard lot because this account you have got $10,000 in it, right? Of course, it's different from an account that you have like $10. So if you have $10 in your account, it's better for you to try to make $1 than trying to make $100. Because most of the time, because in trading, if the trade goes the other side, it can be in loss, right? So that's what a lot size is. So before you place a trade, you determine which lot size do you want to use. Are you going to be trying to make $10 per pip, or are you going to be trying to make $1 per pip? So let me give you a few examples. So first we have what is called a standard lot. So a standard lot is represented by 1. So as you can see here, so if it is written like this, right, it's a 1 standard lot, right? If it is written like this, if you want to risk $1 per pip, you can do 1.01. So this is called a standard lot. And then this is called a mini lot. And then we have what is called a micro lot. This is for very small accounts. If your account you have like $10, $20, $50, it's a very small amount of money. You need to be using a micro lot. If your account is 1,000, 2,000, 3,000, you can be using a mini lot. If your account is around 20,000 and more, or those big amounts, you can use a standard lot, so that the profits and loss can be not very big and not very small. It is going to be relative to your account, right? You can also use some custom lot sizes, like you can use 0.02, right? So, but before I explain this, I want you to understand, just to know this, if you are using a standard lot, you are going to be making $10 per pip. If you are using a mini lot, you are going to make $1 per pip. If you are using a micro lot, you are going to be making 10 cents per pip. So let's say you want to make 20 cents per pip, you can be using 0.02. Let's say you want to make 30 cents per pip, you can use 0.03. So whenever now you are going to be placing a trade, once you think, okay, this market is likely to go to the upside, the first thing that you are going to do is, okay, if it is going to go to the upside, how many pips am I targeting to make? So here's what these lot sizes represent. So one standard lot is going to be written like this, and is going to represent $100,000. And don't worry, you don't need $100,000. The broker is going to give you leverage. But one standard lot represents $100,000. And if you place your trade with one standard lot, you are going to make $10 per each and every pip movement, right? If you use a mini lot, which is 0.10, you are going, it's representing 10,000 units or $10,000, and then you are going to make $1 per each and every pip movement. And if you use 0.01, it's called a micro lot. You are going to be representing 1,000 units, and you are going to make 10 cents per pip. So now, with this being said, you can now see that, let's say you were trading and your currency pair moved, right? So let's say this was Euro USD, and it moved from 1.2020 to 1.2030. What this means is that the market have moved with 0.0010, which is 10 pips, right? So if this market moved with 10 pips, how do I know the amount of money in cash that this trade is going to give me, or that I'm going to lose, right? So I'm just going to multiply this by the lot size. So let's say I was using the smallest lot size, which is the micro lot. The micro lot represents 1,000 units. 1,000 multiplied by 0. Like this, you're going to see that I was going to make 1.00 US dollars, right? If I use the mini lot, which is 10,000 here, I was going to get $10, right? And if I use 100,000, I was going to get $100. Why? Because if you multiply this by 100,000, you are going to get 100, and that is going to be in dollars. Basically, this is how you calculate your profits and losses. So all you want to do is you want to calculate your number of pips that the market have moved, and then you calculate that with profit. So when you're trading, you basically don't have to calculate this much, but then to put your stop loss and your take profits, you need to know the number of pips from your entry to your take profit, or from your entry to your stop loss. We're going to talk more about that, because I have a lesson dedicated for entries, stop losses, and take profits coming up next.